Hope you enjoyed part 1 of Property Market Warning. In part 2, we're going to look at a bit more data. We're going to look at where the property market is likely to be headed, and I'll give my opinions on the property market. So when is this property boom supposed to peak? Well, according to the New South Wales Budget, property prices are expected to peak late this year. And I'll put a link in the description below to Michael Matusik's article that he wrote. It's quite a good one, and Michael Matusik is a pretty smart guy on Australian real estate. He's arguing when we look at this yield curve of the 10-year government bond minus the 90-day bank bills rate, that we're expecting interest rates to move up between 1.5% and 2%. And JP Morgan, cumulative central bank rate hikes, they're expecting, you can see Australia, over the next 4 years, they're expecting about 150 basis points from here. So that will put the variable rate for mortgages somewhere between 4.5 and 5%. And then for servicing, to be able to borrow, banks will service that at anywhere between 6.5% to 8%. And so people's borrowing capacity is going to be limited moving forward if this eventuates. So unaffordable homes, according to the OECD average of house price to income and house price to rent index, it is now the most unaffordable time to buy a house. And yet interest rates are at record lows. That tells you something. And thanks to Martin North from Digital Finance Analytics, his data in May shows that 41.1% of mortgage holders are suffering mortgage stress. Now, he calculates mortgage stress on a cash flow basis, so cash flow in and expenses out, or cash flow out. So basically, it's not just specific on mortgage repayments. So this is, household costs going out versus net income coming in. So you can see 2 decades ago it was a bit over 10%, and even after the GFC around 2011-12, it was around 15%. Now we're looking at 41.1% of households in mortgage stress at record low interest rates. People are stretched financially at record low interest rates, and we're sending first home buyers into the market right now. A Salvation Army survey of its clients found 93% were spending 30% plus on housing, with 86% spending 50% or more. That meant that 53% were unable to afford medical or dental treatment, 28% couldn't afford prescribed medicines, and I believe it was 45% were actually going without meals. My buddy Tarek says, Australia's housing policy failure exposed. Now, I'll put a link in the description below to this Sky News video. It goes for about 5 minutes. They interview the Salvation Army guy, where they break down and discuss this survey that they did. So once again, whether you're looking at Martin North's data, look at this data, people's net disposable income, so much of it is going simply to housing. And we are seeing rents increase at the fastest pace that I can remember. And that is inflationary, and that usually doesn't fall. So it's not a transitory type of inflation input. And this is not good for the economy, for the health of the economy. It's not. Government and central banks have intervened in such a way that we have got so many distortions in the economy right now. We have created so much misallocation of scarce resources and malinvestments. And ultimately, these malinvestments get exposed. So this is an old chart, but debt servicing ratio, you can see that Australia takes a gold medal here. So much of our percentage of our income goes to just servicing the debt. And this has actually risen since then, even though interest rates, as I said, are at record lows. And I've shared this chart before, household debt as a percentage of GDP. Australia takes the silver medal here, a bit over 120% of GDP. Switzerland takes the gold. But if we want to take it back a little bit to the 1990s, you can see that household debt to GDP in Australia, the blue, dark blue, was around 45% back then. We were the only New Zealand had less than us. And now our household debt to GDP is, we take the gold medal there outside of Switzerland. You have a look at the US, we're almost double the US in terms of household debt to GDP. And if you want to go back even further to have a look at the Australian mortgage debt to GDP, you can see it there. And really, late 80s is where a lot of our mortgage debt to GDP really increased significantly. And household debt to income, once again, Australia takes the gold medal here. This chart's a little bit old, so it's actually above 200%. It's around the 210% level at the moment. I tried to find a newer chart for you, but anyway, you get the picture. And once again, it used to be back late 80s, it was around 60, bit over 60% of household debt income ratio. And we were close to being the lowest outside of New Zealand, and now we're the highest. Good one, Australia. The evolution of wages and house prices from 85 to 2018, you can see real house prices and real weekly wages. So wages have not kept up with house prices, and house prices have certainly increased significantly from that. If we go back to the 1970s, once again, you can see that they used to actually track quite well together. There was a correlation there. But then, there was a breakaway in that late 80s period. But then throughout the 90s, it almost closed back up. And then early 2000s, boom, house prices took off. We really stopped building things, making things in Australia, investing in businesses, into real wealth creation, real job creation, real productivity growth. And we just started speculating in non-productive assets, in particular housing. And if we go back even further, we can take this chart back even further to the 1890s. Back then, we actually had a bubble, a housing bubble in the late 1880s or throughout the 1880s. And then it crashed. It actually crashed, 40-something%. And it actually didn't get back to its 1889 high until the 1950s. So for, more than half a decade, Australian housing never got back to its pre-high there. So, interesting chart. Now, I'll put another link in the description below to this article by my good buddy, my good friend, Luke McInnes. If you on Twitter, I recommend you follow Luke. He's a great macro thinker and a good buddy of mine. We share a lot of thoughts privately and bounce a lot of ideas off each other. We think very similar about things, about the whole macro, about the economy, about inflation, deflation, all that sort of stuff. But he wrote this interesting article, The Property Crash Where Prices Will Skyrocket. And that's certainly on the cards, in my opinion. And so you must read it. That's certainly something that could happen. We'll see. Now, be careful, folks, hearing so-called experts, hearing economists and people who the media put up there as, gospel. Listen to them. Remember our mate John Maynard Keynes, who said in 1927 that there would be no more crashes, where the great Austrian economist Ludwig von Mises said a great crash was coming, and, well, lo and behold, we had the 1929 stock market crash, which led to the Great Depression. And it's funny, John Maynard Keynes was always wrong. He always changed his mind. And his book, what was his book? That basically modern economics is based on. I've forgotten it. You guys will be able to tell me in the comments. Anyway, it was asked Friedrich Hayek, why didn't you debate him? Why didn't you pull apart that book and whatnot? And Friedrich Hayek basically said, well, the guy changes his mind all the time. That book was so horribly wrong and so inaccurate and whatnot that I just figured he was going to change his mind. So why would I bother debating it or pulling it apart? It was so awful, such an awful book and so incorrect that he would change his mind the next day anyway. And anyway, it didn't. And we've unfortunately had to experience Keynesianism economics. So one of our Keynesian economists here in Australia, former advisor to a particular prime minister and political party, I won't mention who, but he said house prices are surging because of low supply. It's economics 101. He even said, look at Perth. Now, you can see the date there, October 2016. So let's go and have a look at Perth. So look at Perth in the yellow, look at 2016, and property prices, what were they doing? Which way did they go? They kept going down, didn't they? Housing supply. So it's all about housing supply, he says. Well, you're going to see shortly that some other so-called experts say that supply and immigration's got nothing to do with it. And even central bankers, are they incompetent or worse? I don't know. But the central banks predict a soft landing for housing in Ireland just prior to the Irish property market crash, which fell about 56% from peak to trough. And with that, let's have a look at some more bad predictions about the property market crash. So house prices in Ireland took about 6 years. As I said, the average time for a property market to crash from peak to trough is around 5 to 6 years. Doesn't fall like the stock market does. So why didn't house prices last year in Australia fall? Well, we had huge government benefits. In fact, you can see here that wages and salaries paid, you can see that people actually were better off financially because of all the government benefits. People were able to take funds out of their retirement accounts. They received all sorts of different government grants and wage subsidies, etc. And so we've actually seen savings actually skyrocket. And even though all these wage subsidies have ended, and those savings has actually come down a little bit. When you look at it throughout time, it's still way, way high, way above what it usually tracks at. So people are still sitting on big, large sums of savings. The other thing is, and look, this has been a trend for a little while, but property transactions. So people weren't forced to sell last year. If you lost your job or if you were suffering in any way, shape or form economically, you were able to defer your mortgage repayments. Now, yes, it doesn't mean that you got a free lunch and that you don't have to make those payments. They were either capitalized on top of the loan amount, either the loan term got increased, or eventually when people had to start paying, their repayments increased. But basically, people didn't have to sell. They could take a mortgage holiday and not sell. And so supply, the number of properties on the market for sale, completely dried up. And so that's what's created this supply-demand imbalance, where all of a sudden with lockdowns and whatnot, people wanted to get out of the cities, and people wanted to move and whatnot. Yet there was no supply. Real estate agents still tell me now that they are struggling to find listings to, have properties on the market. Yet there's still a lot of demand. There's still more buyers at the moment than there are sellers. And we know of clients and people that have gone, well, you know what? Because of what's happened with property prices, people that do need to sell are pushing off that sale. They're like, oh, look, if I can hold on for another 6 months, I'll be able to sell my property for a lot more. If I can hold on for another 12 months, then I can sell my property for a lot more. There's a lot of people in financial distress at the moment that have seen what's happened to property prices, and so they are delaying the sale because they're seeing them go up, and they think the longer they can delay that sale, the more they can get for it. So we've initially started with people not being forced to make repayments. So people that might have been in a position that they had to sell didn't. And other people who were in kind of distress that needed to sell have pushed it back as much as they can. And so we've created all this demand at the same time that we've allowed supply to decrease because people haven't been able to sell. People haven't been forced to sell. The problem is we've brought forward so much of that demand and we're seeing that demand ease, especially with first home buyers now. But as these people, if whether it's interest rates rise or eventually they just go, look, we're going to have to sell now. We're getting really, really tight. We've made some good gains. And sales start to outpace buyers. As I said, where's the demand coming from? Because we brought so much forward. What's behind that? There's a big gap, big hole there. I don't know where that's coming from because I don't see international borders just opening and people just flooding in. And supply. If interest rates rise even a little bit, that's really going to force these people who have been delaying selling their homes to do so. And you can see Brisbane, Sydney, since about 2015, there's been a lot less supply on the market. Interest rate changes, not supply, the key for house prices, an RBA paper says. Changes in interest rates are the primary driver behind the movement in house prices and not supply and demand, according to a Reserve Bank paper that appears to contradict the bank's governor. The most significant driver behind house prices and the level of construction was interest rates, says an analysis, a model of the Australian housing market by RBA analysts Trent Saunders and Peter Tulip. Now, those of you that watched my last video will see that I talked about Dr. Tulip. And I'll say a little bit more about Dr. Tulip in a second. So anyway, the RBA apparently, according to Trent Saunders and Peter Tulip, says that it's interest rate changes, not supply. Most embarrassingly for the RBA, two of its top researchers, Trent Saunders and Peter Tulip, published a detailed academic paper shortly thereafter, proving that almost all of the stunning increase in house prices between 2013 and 17 was indeed attributable to the reduction in mortgage rates. For the avoidance of doubt, the RBA economists demonstrated that housing supply and population growth had comparatively little influence. Okay, so they say that housing supply and population growth had next to no influence. What I know with certainty is that the RBA's own research finds that a permanent 1% reduction in real mortgage rates will lift house prices by a stunning 28%. Okay, well, I got a question here. If a 1% reduction in real mortgage rates lifts house prices by 28%, now that we know we've bottomed in interest rates and that yields have risen and interest rates are likely to rise in the coming months and years, what does that mean for house prices? If 1% reduction increases house prices by 28%, what would a 1% increase in mortgage rates do to house prices? Don't know. So RBA's the Tulip, the bloke who praised the stability of the Icelandic banking system just before it collapsed, has now written a piece on apartment supply. The shortage of apartments is most severe in the inner suburbs of Sydney. So here's Dr. Tulip. Okay, now, by the way, he praised the stability of the Icelandic banking system just before it collapsed. That's how good he is. Wrote a paper that in 2019 it was, that said that supply and immigration have no effect. It's all about interest rates. And now he's written a piece saying that it's the shortage of apartments in Sydney. And he wrote this last year. The problem with this is residential vacancy rates in Sydney skyrocketed. And this is why I try to bait this guy on Twitter to get him to debate me, because he's just pretty much what he says. If you do the opposite, you'll do well. So when we look at house prices, all right, and where they headed, what are they going to do? Remember back in 2018-19, over that 12-month period, okay, before the federal election, when unemployment was 5.1, 5.3%, something like that. We had no lockdowns. We had no, the economy was going okay, apparently. We saw Sydney house prices fall nearly 11% in that 12-month period. And in Melbourne, 10%. Brisbane, a little bit less. Perth, 8.8. Darwin, 8.6. But Perth and Darwin had been falling for some time. But just for that 12-month period, we saw house prices fall. That's actually stunning. I every time I look at this, I go, wow, they really did fall by that much. Now we've got a very sick economy. Interest rates look like they're going to be rising. Even though the government are praising the unemployment numbers, Roy Morgan say the unemployment numbers are very, very different. And so I recommend you check out Roy Morgan and follow their data, and you'll see how they measure it compared to the ABS. But here's the thing: if house prices can fall that much in 1 year when we've got high immigration, relative low interest rates, relative low unemployment. What are they going to do moving forward with the debt bubble that we've got and as interest rates rise? So when we look at the price changes by decade, you can see that 99 to 2009 period was really when house prices did extremely well everywhere, nationwide. And for all the talk that a lot of experts have been saying for the last decade that Brisbane's the place to invest, Brisbane's going to boom, Brisbane's about to boom. In the last decade, or from 2009 to 2019, Brisbane only went up 8.5% for the whole decade. The whole decade. So, these so-called experts, when you take into account inflation, and the cost of borrowing and the cost of holding a property, Brisbane real estate's done terrible. So you need to really think clearly about asset classes as an investment. Buying a home to live in is completely different. I'm more focusing on investing, whether it's investing in precious metals, stocks, trading options, or buying real estate as an investment. I'm looking at it as an investment. Buying a home is completely different. When people say to me, should I buy a home, or should I sell a home, or whatever, that's a different conversation to should I buy an investment property or should I sell an investment property. But yeah, once again, if you have a look at Perth and Darwin in the kind of browny orangey, from 2014 all the way through until last year, it was falling. In fact, it fell 30%, more than 30%. Perth about 20%. So properties can fall, and as I said, in that 2018-19 period, that 12-month period, houses fell in Sydney and Melbourne 10 and 11%. So don't think that it can't happen here. Don't think that it can't happen like in Ireland. People say that, well, you can't compare the US to Australia because they have non-recourse lending, we have recourse lending. Well, the truth of the matter is that in the US, most states actually have recourse lending. I think it's, I've done a video before on it, but it's about, 11 out of, all the states in America have non-recourse lending. The majority of them have recourse lending. And in Ireland, I've said this in a previous video, that in their property market, you don't make your repayments, you default on your debt. Under their law, you can actually go to jail. So they not only do they have recourse lending, but you can actually go to jail. I don't think anyone did go to jail, not that I know of, but they had that in their law. So the fact that people say, well, Australia can't have a property market crash like Ireland or the US because either we got strict laws, we got recourse lending. Well, they had it in Ireland. In fact, their laws were stronger, and the narrative in the US is that they've got non-recourse lending. No, only about 11 states have non-recourse lending. It's a misnomer. So it's just not true. In 2017, APRA did a bank stress test. The scenario was a macroeconomic scenario with a China-led recession in Australia, 4% fall in GDP, house prices declined by 35% nationally over 3 years, and unemployment rate increased to more than 10%. That's basically our banks. That's what they can handle. So if we have a 4% fall in GDP, 35% house price decline over a 3-year period, and unemployment at 10%, our banks are in big trouble. So is our property going to end up like Japan? A lot of people say yes. I personally don't think so, but some say that it is. The Japanese property market skyrocketed in the 80s and then crashed in the early 90s and has been down ever since and never got back to those highs. But they have a demographic issue that we don't have. I mean, we've got a demographic issue, but not in the ballpark that Japan had. So with Japanese, when you take out their peak buyers and dyers, I mean, it all made sense. The Japanese story made sense, but I don't see that happening in Australia. Now, Harry Dent, so these are his charts. He says that Australian housing is 42% overvalued. He says it's going to crash down into 2022, then bounce and then down again when he looks at Australia's demographics and whatnot. Now, Harry was also saying that property was going to crash like 40, 50, 60% or something last year. That didn't happen. I'm definitely not bearish in the Harry Dent camp, but I do think Australian housing is overvalued, and moving forward, in my opinion, I see more downside risk than upside gain in Australian real estate as an investment. I believe the interest rate cycle has bottomed. Whether the central banks try, like the RBA tries to do yield curve control, we've seen with the 3-year that's gone from 0.05 up to 0.5% in 2 weeks. So that tells me that the RBA aren't in control of the 3-year. Even if the RBA don't lift their short-term rates, as rates rise in the US, our banks are going to have to pass on higher rates because our banks borrow from the overseas markets. I don't see the borders opening up and the same immigration that we had, the high immigration levels that we had over the last decade or so. Our economy is sick. Our economy, on all different metrics, looks sick. We've got huge amounts of government debt, household debt, corporate debt. Taxes are going to have to rise. Inflation is coming. I mean, there's just so many headwinds for real estate as an investment. I mean, all the tailwinds that you could have wanted has been behind property, and those tailwinds are just absolutely blown out now. That they've run out, and maybe the government will come in and go, right, everyone can take their whole superannuation retirement accounts and buy property. I don't know. I mean, some backbenchers are calling for superannuation to be used as a deposit. So who knows what they try to do? Look, economist Lindsay David, he's written a book on this, and I recommend looking at some of his research. He's worked out, if this was to happen, what would be the best way for the government to get out of this problem. I recommend checking out his work. But definitely everything that I'm seeing, just that risk reward, I see that the rewards to take on so much debt, to take a negative carry because they don't have positive cash flow to cover the mortgage and all the holding costs and taxes and everything else. So you're simply negative gearing, hoping that property would just go up in value and that you'll sell it and make a capital gain in the future, that someone will pay more for it. I mean, to be honest, I would much prefer buying leap options and buying gold and silver explorers to get capital gain than and for less risk and much more gain than taking so much risk for such little gain, in my opinion. And so for me, I ain't touching Aussie real estate as an investment. I'm much happier investing in other assets. And in my next video, I'm actually going to talk about that, where to invest in today's economy. So anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like the video, hit that like button. If you haven't yet subscribed, do so. Hit the notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.